Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Real Estate Investor Bookkeeping.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today we'll be talking about real estate investor bookkeeping. Now, I know what you're saying. Man, this sounds like such an exciting topic for us real estate investors, but it is a very important topic to us if we want to avoid or defer some of the taxes that we owe in this industry, and to make sure that we stay out of trouble with the IRS. And so to discuss this very important topic, from a real estate investor's perspective, I invited a friend of mine, Chris Pawlowski of VIP Accounting Solutions, to have this discussion. Chris, welcome to the podcast.
Thanks so much, Scott. I appreciate the opportunity to be here.
Well, I'm really glad you are here, because I think this is a topic that a lot of people kind of shove on the back shelf, back burner until they can't shove it back there anymore.
Yes.
So I thought we would, kind of start the interview with some questions that I prepared and talk a little bit about, how to attack this in kind of an overall perspective. What are some of the common mistakes? Trust me. I mean, as business people, especially new business people, new business owners, there's a lot of mistakes we make regarding our accounting and our bookkeeping. So I'm hoping that that's something that you can help with. And, and so I guess let's start with this because I got a bunch of questions.
Sure.
So let's start with this, before we go full on real estate.
Sure.
Let's tell the audience here a little bit about VIP Accounting Solutions.
Well, VIP Accounting Solutions was actually started about 10 years ago. My partner and now wife, Christy Pawlowski, has got 30 years of experience in high-level accounting, as a controller, as a CFO, owner of multiple businesses. And what she saw a long time ago was that business owners don't have a Christy. They try and do everything on their own. And a lot of times things fall through the cracks in terms of just things that they wish they would have known. But I came aboard about 8 years ago, and I come from the science background. I come from, I studied chemistry and biology. And one thing that I found really quickly when talking about accounting to business owners is that good data in science, like for a clinical study, is the same as good data for your accounting.
Isn't that true?
And how you structure a clinical study and how you structure and put together your accounting and your bookkeeping really makes a big difference in the end product.
Right.
What we've been doing, I mean, just for an example, you have a multi-million-dollar business that was doing their taxes and needed to have their financials reviewed. Christy found over $2 million in missed write-offs that really significantly impacted their tax liability. So think about that for a second.
I mean, that's huge.
Yeah.
I don't care what tax bracket you're in. That's huge.
It doesn't matter. But the point I want to make here is if you don't have things structured and you're not paying attention to the details and things that matter in terms of being able to defer taxes and being able to take advantage of those tax write-offs,
right,
you don't know what you don't know. You end up paying a lot more in your taxes.
Yeah, and I run into that with real estate investors, especially people who have only been doing this for a few years. Mm-hmm. They get caught in that area in between what's business, what's personal, what is short term, what is long term, and we'll talk about some of those things. Yep. But maybe you can talk a little bit about the company's experience with regards to the real estate investing industry,
sure,
and kind of what it is that you guys bring to this. How when you got started, how long ago that happened?
Gosh, I'd say, we've worked with real estate, agents and brokers in the past, and typically, those kind of expenses that they have, they're pretty straightforward in what we can do in terms of setting them up for the books that they have.
Right. Mileage.
Yeah, mileage, hard cost, and, seminars that they go to, everything that they don't realize they can write off.
Right.
And one of the biggest mistakes that we see that, real estate investors make is they try and do everything themselves.
Right.
They try and use their, single bank account, their single credit card, and say, well, I can just write that off later. And that's a perfect example. If they don't know what they don't know.
Right.
And so then at the end of the year, they realize that they've been maybe commingling funds, and now they open up themselves to more liability and remove any legal protection they have if they had it under a business.
Right.
So we are actually able to work with LTIC, LT Investments and Consulting. Leslie Todd, who's got 35 years of real estate investing. And when we met her, she really needed someone that could work with her hand in hand to make sure that bookkeeping is in line with the real estate industry, which is slightly different. So being able to partner with her, we've really been able to bring just an added dimension to VIP Accounting Solutions and work with her to really help real estate investors take advantage of all the work they put in to create those profits.
Right, absolutely. And there's something that you said that we don't hear a lot of times from bookkeepers, because a lot of times they're really down in the bean counting type area, but it's liability. I've worked in the legal arena for a long time, and one of the things that you'll find anytime that you do get into a legal issue and you're going to court, is one of the first things you'll see in any pleading from opposing counsel will be they want to pierce what they call the corporate veil.
Absolutely.
So that they can go through and assign personal liability to your business. Yep. And so what you said there about the commingling of assets and funds, if you treat the business like it's your own personal entity, then the courts will go, it was your own personal entity. Yeah, and that can lead to some huge risks.
And a lot of times by treating it as your personal entity and operating that way, you then end up paying taxes like it's your own personal identity, which is a lot different than if you took the time to set up that business structure, whether it be an LLC or an S corp, and that's something that a tax strategist can really help you put that structure in place to prevent those challenges that you have.
Well, let me ask you this then, because this kind of leads to my next question. Yeah. So why then is it? Let's talk about why it's important then for real estate investors to really set their real estate investing businesses up instead of running as personal, but to have a business. What would be the advantage, the reason you'd want to structure it that way?
Guys, well, you want to structure it that way because you can run things through your business instead of paying it personally, which makes sure you get taxed differently. Okay. And there's a lot of things that as a real estate investor that you don't realize you should start paying through your business. Right. Things that, I'm going to learn about real estate investing, so I'm going to go to a seminar. I'm going to get a coach. Those are directly related to educating your company. Right. So by setting up an LLC or S corp, depending on tax bracket and a lot of other factors, your travel to research properties, your accounting fees, your legal fees, your home, your internet, your vehicle. Those are all things that while you use that personally to go help your business, if you run those as business expenses, which they really are, right, it changes the way that they're taxed at the end of the year.
Yeah, I've always said for not only with real estate investors, but I've always said, for probably 35, 40 years, everybody should have a business. Yeah. It's much better to pay your expenses with pre-tax dollars than to pay them with after-tax dollars.
Absolutely.
Because you have a discount. Yeah. And the neat thing is, and this really isn't in the accounting sector, but you kind of brought it up with regards to LLCs and S corps. The nice thing is with an LLC, you can treat it as a partnership. You can treat it as a single individual corporation, or you can treat it as an S corp with pass-through income. I think it's by filing like Form 2553. Check with your tax,
tax strategist,
or whatever. Right. But what it does is it gives you the ability to do things much more economical as a business. Who doesn't want to save money?
Well, to your point, I had this conversation actually with our 17-year-old in terms of the difference between, working as an employee versus owning a business. And I use a real simple example. If you made, say, $100 or $100,000, as an employee, you're getting taxed right away on that W-2 form. So
Social Security, Medicare, income tax, all of this stuff, unemployment tax, everything.
Exactly. Yeah. So you take the taxes out. So the $100,000, you take 20% out, you've got $80,000. Now, as an employee, now you get to pay your expenses, your house, your car, your phone, your internet, everything from that standpoint. And that leaves you, you're looking at $16,000. That's going to be taxed then. Right. So you really spent $64,000 in all of your expenses, everything out of that $100,000 that you made. Right. Now that's as an employee. Now as a business owner, watch how this changes. You take that same $100,000, but instead of being taxed on it right away, you use that $100,000 to pay those same expenses. The house, the car, the phone, the internet. You write off a portion of your house.
Right.
Those are all things that you can do. So you use those expenses, and then you're taxed the 20%.
Right.
So you reduce your tax liability, but you get to spend more money. And I'm not saying to do, when you go out to meals, to talk about those businesses, if you're treating it as your own personal business, well, then you're paying your personal funds and you're not able to take advantage of that.
Right.
So at the end from that equation, you've spent $80,000 and you're getting taxes on $4,000.
It's a huge difference. The tax code, for all that we complain about how big the tax code is, the tax code really is set up to penalize workers who earn paychecks, and to benefit those who have businesses.
Absolutely, and that's a great point. I mean, we were talking with Leslie, and she said, there's so many variables because the tax code changes every year.
Right.
And when you think about it, if you think about those old school encyclopedias that are this big, she gets the master tax guide every single year.
Yeah, and that's just the changes. That's just the changes every year.
That's just the change. Like for instance, people just say, I can write off my vehicle 100%. Well, that used to be until they had the Tax Cuts and Job Act in 2017.
Right.
Then they started phasing it out.
To depreciate.
Instead of 100% of the car, now it's 80. Now it's 60. Now it's 40.
And you couldn't write off interest.
Exactly.
On automobiles anymore.
Yeah, exactly. So you think about the tax laws that change every year. It's like a Rubik's Cube like this, and it changes every single year of what you can write off.
Right.
Now, if you're trying to do this all yourself, how are you going to keep up with that?
Yeah.
Most accountants don't keep up with it.
They can't keep up with it.
It's just an ever-changing.
No, and I will tell you, though, this is a different topic. I'm really excited about the tax package right now that President Trump has proposed and that Congress, both House and the Senate, are moving forward, because if you're in manufacturing, you can write off 100% and expense 100% of it.
Yeah.
So what does that mean? Then we just need to figure out how our businesses fit into the new tax code so that we can take advantage of being able to write that off.
It's that changing puzzle, but if you stay on top of it and have that strategy and that strategist, you're going to be able to take advantage of that.
All right. So next question.
Sure.
What are some of the biggest challenges that small business owners create when starting a business when it comes to their accounting? Yeah,
some of the challenges that they create is, we just alluded to that earlier, they try and do everything themselves.
Okay.
And by doing that, they unintentionally mix their finances. And we talked about that before. You pierce your corporate veil. Now you open yourself up to lots of legal liabilities. If someone were ever come after you, now they can't just come after your business. Now they can come after your own personal house and all your personal assets. So that's one of the big things that we see. Tracking expenses as well, too. Sometimes what we've seen business owners do in the past is they just rely on that bank statement. They rely on their credit card statement and say, I'll be able to figure it out in the year. If you're not tracking it throughout the year, what would, when you think about a business meal,
I just can't use the brown paper bag.
You can't use a brown paper bag. We've seen that. Believe me, I've got pictures. But think about that. If you don't capture it exactly, who you went out with, what you were talking about, think about who you went out with 2 months ago and had that dinner meeting for.
Yeah,
Can you remember? Try to remember that at the end of the year when you have to do 12 months of it. So those are big things, not tracking your expenses. And then the other biggest thing is, you're not hiring a pro. You're not hiring someone that could handle your legal property or an accounting professional.
And they're going to see the things you don't see. They're looking at things differently. And it's really funny because just on the real estate investing side of things, I own a contracting company. And I've been an investor for over 35 years, right? When we buy a lot of our houses, I'll send home inspectors in there. Do I need to? I've got a whole crew of guys that know. But the problem is sometimes we get so excited about the deal that we overlook the problems.
You let the emotions come into it.
Yeah, and so a third party will come in. He's unemotional about it. And all of a sudden, he's found broken trusses in the ceiling. He's found mold in an area that we probably wouldn't even have looked in. We would have just said, "Hey, we'll just take care of it on the remodel." But now it becomes a negotiating tool. I can go back to the seller now and go, "Hey, look, when I bought this, I assumed all the trusses would be good. I assumed you wouldn't have mold. I assumed all of that kind of stuff.
That's going to incur cost to fix."
And so hiring a bookkeeper is kind of the same way.
Absolutely.
Because I will tell you, there's nothing like getting to the end of the year, finally going to your bookkeeper or your tax preparer, having them add up all the things that you were just talking about, and then going, well, it looks like your tax liability is going to be $25,000. Yeah. And then they go, I didn't save $25,000. I went to Tahiti.
Right.
I bought a new car.
Yeah.
I got new jet skis. All of that kind of stuff.
Absolutely. That was the other biggest mistake is you wait until tax season to finally bring your things to a tax professional.
Right.
And during tax season, accounting is one of the only industries where every single client in every facet of business has the same deadline.
Right.
So to bring it to them at the 11th hour and say, hey, can you figure all this out? That's just a recipe for disaster.
Yeah. Well, they call I found out about this thing like 35 years ago, and it's called an extension.
Absolutely.
One of the reasons I actually found out about it is because I used to travel over to Southeast Asia in the springtime every year. So I wasn't here to do taxes.
Right.
And so, my accountant at that time said, hey, we'll just file every year. We'll just file an extension. When you get back from your trips, then we'll do all the taxes. But that's not an excuse for waiting until September 13th
Right.
when your extension's about to expire
Yep.
and taking everything to the bookkeeper and say, hey, I got to file taxes in 2 days. Can you help me out?
Exactly. And sometimes those habits repeat. And now you're at the end of the tax extension deadline and you're really up against it.
So now you've touched on this quite a few times here, but let's talk about and you kind of gave an example that you had with your son with regards to separating taxes. But let's talk about the separation of the receipts or the expenses from personal to business. And what does that do then for my tax bracket, my tax liability? How does that help me? Why wouldn't I just run as a sole proprietor and just throw everything together and just accept the liability? And
Well, you run as a sole proprietor, you're really running everything through as yourself. And it just doesn't give you the same benefits in terms of running it through as an S corp or an LLC where you have that business entity. Because remember, it's not the individual that's being taxed; it's the business entity, and a lot of times
Right.
you have to remove yourself, from that. And from the business standpoint, I mean, keeping proper receipts and running things that way, that can affect just how you're going to pay tax. There's so many variables that come into play, whether you're a house flipper or you're a long-term investor. I mean, if you're a house flipper, typically you're holding onto that property for less than a year. You talk about things like depreciation. You can't take advantage of that if you're
Right.
a short term. If you're a long term investor, then you can take advantage of that, and that has a lot of benefits for you from that standpoint.
okay, so obviously, if we set up a business, we then get the protections. The wall of separation, we'll say, is an LLC. There's that corporate veil that kind of protects us. We get some advantages because we can pay things that we may not be able to pay personally. We can pay them through the business, and they're pre-tax dollars, which saves us. In the example that you gave about your son when you talked to him about the earnings
Running it through,
income.
Yes.
And then, obviously with equipment and assets and stuff that you can depreciate. So, for instance, if I was to buy, an 8-plex and put it into the business, I can depreciate that asset then. And how long do I have to hold it before it changes from maybe a short-term gain or a long-term gain?
Typically, it's over a year. If less than a year, you're considered short-term, investment. So it's that where, in a long term, it varies whether, your income, whether you're a real estate professional, but it also affects the amount of taxes. As a short term, as a seller for less than 1 year, you're going to be taxed up to 37% from an individual rate.
So if you made $100,000 on a turn, on a flip or something, depending on your tax situation, you could be taxed $37,000. The government didn't do anything.
Nope.
But you made 63, they made 37.
Just because you held it for less than a year.
Just because you held it for less than a year.
You held it longer. Now it goes into kind of what your tax bracket is. You can be taxed either 0, 15, or 20%.
Right.
Significantly lower in terms of the maximum.
Right.
And you're going to also protect yourself from liabilities, like we said, because you're running that through a business.
Right. And I know there's a lot of guys out that do what we call house hacking. So what they'll do is they'll buy a house, they'll remodel it, but they'll live in it for 2 years.
Yeah.
Then they'll sell it and take advantage of the personal exemption of $250,000 per person. So for married couples, $500,000, and can then avoid capital gains altogether, long term or short term.
Right.
because they made it their principal. You get it, what is it, 2 of the last 5 years? I think it's
so.
two of the last 5 years. And so there's some advantages to doing that. The only problem is it's a slower process for those of us who are
You've
doing.
got to be able to change
more
residences and live there for a year.
Well,
or two.
yeah, you got to have a wife who's willing to do that. And my wife has been. The fact is, where we have the podcast studio now is a property that we house hacked. We're going to actually turn the property here. We built the podcast studio in it, but we're actually turning this into a co-living facility. And my wife said when. I said, well, when the right deal comes up.
Right.
As an investor, I mean, we buy a lot of houses, but they're not ones I want to move into.
Right.
And so we have our eyes set, and again, as a wholesaler, we're digging through all of our wholesale lists to do that because we want to take advantages of the taxes on the property. So we try to buy these things, hold them. This one we're doing a hack, so this one we put in our personal, but like the other properties we have them in the business, and we're taking advantage of the depreciation. Yeah. Okay, so what portion of my profits as a real estate investor should I be putting away in the business in order to make sure that I have enough money to pay my taxes at the end of the year?
That's a great question. Typically 20 to 30%.
Okay.
Put it right aside from that statement.
So if somebody said, hey, maybe 25%, that's kind of, if we just put 25 away. So for instance, if you made $1 million and your taxes were $300,000 and you had 250, you've only got to come up with 50,000.
Correct.
Okay. Well, hopefully if you're making $3 million, you can come up with that.
You can come up
with 50. But let's say you make 300,000, right? Now it's just dropped zero off everything. So now you've got 25,000 in the bank. Your taxes are 30,000. You only got to come up with $5,000.
Right.
So it's something that's much easier to bite off.
Absolutely.
So, but between 20 and 30%.
20 and 30%, because you also have to take into the, if you sell it, you could have that depreciation recaptured.
Right.
And you're going to have to pay taxes on that. You also have state taxes if they're applicable. So you have other taxes as well too. So
okay, so that's a good one too. So how do I defer then those depreciated expenses?
Using a 1031 exchange is going to be the greatest way to do that, and it's going to do three things. To use a 1031, it allows you to use tax referral for like-kind properties. So you can't use a multifamily home and a single-family home. You want to use the same types of properties. And what that allows you to do, three things. It allows you to defer your capital gains, so you can reinvest that back into other properties.
Right.
Secondly, what it's going to do is it's going to increase your buying power and take advantage of compounded growth.
Right.
So you're taking those profits because you're using a 1031 exchange. You're able to defer that, put it into another property, increase your wealth that way. And the third part is you can diversify your portfolio as well too.
Now I've done and been involved in several, 1031 transactions, but something that I hadn't thought about before. Is there a requirement on the hold? Now I know you can't move into one that you have purchased with a 1031 for it's either 1 or 2 years. Check with your tax advisor. Before you can make it a principal residence of yourself. But if I was to buy something, say I sell property, use 1031 and move it, do you know how long I have to hold on the one I moved it to?
Yeah, there's timeline regulations and also property type. So from a timeline, you have 45 days to identify that property.
Okay, yeah.
Use a 1031.
That's to identify your next purchase.
To identify your next purchase, and then you have 180 days to complete that purchase.
So you got a half a year, then 6 months basically to actually complete the purchase. So now I complete the purchase. Do you happen to know? Because this is something I don't know. What happens if in 3 months I get somebody that walks up and goes, hey, I'll give you twice what you paid for that one. Can I 1031 that money out again? I wonder.
I don't believe you can.
Oh, okay. Yeah, I don't know how long you have to hold it in a 1031.
Yeah.
All I know is the money can't come to me. I have to have a 1031 company, a third party.
Usually, I was going to say you have to have someone that take a hold of that for that time.
Otherwise, the IRS considers it this thing they call boot, and boot's taxable.
And you know, trying it. The whole name of the game is avoiding that.
So I remember we just did one out in Goodyear with another investor, and he was selling multiple properties, 1031ing them all into this multi-million-dollar house that he was building.
Okay.
Through his 1031 won, but he needed to pull some cash out. And I know that he got back to me. He wasn't real happy. He had a conversation with his tax advisor, and they said it's going to be boot. It's going to be taxable. He was trying to obviously avoid all of the tax.
Another reason why having that tax strategy is so important. Even if you're a seasoned investor, there might be some things that are changed that you're not aware of.
All right. So you mentioned depreciation. So let's say that I buy a fourplex. Okay, and now I've got it filled with tenants in there, and they're paying rents every month. And you mentioned something called depreciation that you can offset against the profits. Yeah. How does that work on a residential property as far as depreciation? Well,
depreciation is your building cost plus the improvements, and when you depreciate it, like you said, to take a loss to offset some of your income, rental property owners can depreciate that property over 27 and a half years.
Okay.
Now, if it turns into a commercial real estate transaction, then you can do that for 30 years.
So commercial buildings are 30 years and residentials are 27 and a half years.
Yep.
And then again, if you use the 1031 you were just talking about, any of the equity that was built because of the depreciation, you can actually use a 1031 to defer that by moving that money into another investment.
Yeah, and another way to look at it, you say you have a $275,000 house. 27 and a half years, you depreciate at $10,000 per year. So you take that loss of $10,000 per year. So if you made profit of $5,000 from that rental property, you actually didn't make a profit of $5,000. You actually had a $5,000 loss. Which is counterintuitive.
A book loss.
A book loss. But it's actually something that seems counterintuitive, but for a new real estate investor, he might not be aware of that.
And the IRS says,
yeah, you didn't
pay me now, or pay me later.
Yeah, but I didn't know. And they say we don't care.
Yeah, we don't care. I remember I was trying to buy a commercial building. We had a computer manufacturing company back a long time ago, and the building where our primary offices were, we were trying to buy it from the lady, but she goes, I want to sell this, but she says I can't. She says I completely depreciated it, and if I sell it, I'm going to have a huge capital gains bill. And so she was facing that same thing. Yeah. And we ended up never actually working it out. We ended up buying another facility.
Sometimes the numbers don't add up.
Yeah, they just don't work. Okay, so one last one.
Sure.
Okay, what should I be looking for? I mean, obviously, VIP Accounting Solutions. You guys have experience. I mean, in bookkeeping and accounting. Yep. And you can help people from kind of end to end, so they have everything that they need to go to their tax professional.
Best data possible. Yep.
And so when I'm looking for a bookkeeping like VIP Accounting, what if I live in Florida or Texas and I'm watching the podcast right now and I'm sitting in Las Vegas? Can you help people that are all over the country, or are you just local to the state of Arizona?
We can actually work with anyone in the United States, which is great because every state has different tax laws, different tax rates, even different tax rates per city. So you have to look at everything. There are so many variables. And then you throw on top of what we talked about before about the master tax laws changing every year. It just makes it a challenge all the way around. But
you could help people in all the different jurisdictions get an understanding, get on top of their books for their real estate investing.
Absolutely. And especially now, with our working with Leslie at LTIC,
right.
We can really put a strategy together to really minimize those liabilities long term.
Right.
Maximize your profits.
Well, VIP Accounting Solutions information is there on the screen if you're watching this, on one of our video transcribed, podcast. Otherwise, you can get hold of VIP Accounting Solutions. They're here in Arizona, and their information will be in the contents information of the podcast that you're listening today. I want to thank everybody for joining us on this episode of the Whitwam Wealth Real Estate Podcast. I invite you to subscribe today and be part of our growing community. And be sure to check out our growing list of previous episodes related to other topics. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.